Well, just 4 days to go for the budget, so all set to get set and grow. I hope that that's applicable for everybody. But yeah, back to the markets then, and I think 2020 has kick-started on a decent note, especially for the mid and the small caps, because we are seeing a nice, decent recovery come back. Very often we get worried questions from a lot of you guys, from a lot of our viewers about their investments that they have made in small cap mutual funds or in mid cap mutual funds, and how the NAV has fallen. But look at the story that we are seeing this month. That's basically Jan 2020. There's been a nice 7.9% rise in small caps, and we're just about 28 days down this month. The mid cap index as well has shown nice, decent recovery, about 6.5%. And don't forget that if Nirmala Sitharaman delivers a budget that the markets will be pleased with, then you perhaps could see more legs to this rally that we have been seeing in the mid and the small caps. In fact, especially if we compare it with the Nifty and the Sensex, it's interesting to know that the small and the mid caps are actually outperforming versus the benchmarks. It's a factor that we haven't seen in a very long time. So as mutual fund investors who of course are not used to dabbling in individual stocks and you rely on the mutual funds essentially to help you profit from the India growth story, profit from the Lal Street, how can you make money out of this bounce that we are seeing then in the broader markets? There you have it, the proof is in the pudding. A 10% rise in small cap index, a 7.5% rise in the mid cap index, and if you look at it on a 3-month basis, the bounce is actually more. So a lot of us attempted to put our money in then in the mid and the small cap indices. How can you do so? Well, I have with me Lovaii Navlakhi, MD and CEO of International Money Matters right here in the studios. Mr. Navlakhi, thanks so much for joining us then on the Money Show on ET now. And I suppose you did see those numbers, right, appearing on our screens about how the small cap index and the mid cap index gained. And many a times, I'm sure you as well get this question from your clients that, oh, I've invested in so and so small cap fund 2 years ago and now it's losing. What should I do? Do you think that now if we're seeing a bounce, and many are saying that this will continue, do you think that mutual fund investors should relook at their SIPs, how much large cap they have, how much mid cap, etc.?
Yeah, I think one of the things that you did show was the 1 month, 3 month, 6 month return.
Yeah.
And it looks almost too good to be true for people who have invested because they've lost money.
Yeah.
So if you extended this to a 3-year period, the small cap index has actually lost money, whereas the large cap index has ended up with a 40% gain in the last 3 years. So I think that what is important when you are investing in equity is that you're looking at valuations, and I think the valuations are the key more than how the performance has been. So if you do see that, and we do see that now, that the opportunity to make money is more in mid cap than in the large cap space. So yes, it is a good time for you to slowly bump up your allocation to mid and small cap. And of course, if you just looked at 1-year returns, they won't look very good. And don't get very tempted with the 3-month fantastic returns as well.
Yeah, well, we often say, right, that when you invest in funds, in mutual funds, you should have a long-term time horizon. You shouldn't actually be looking at 3 months, 6 months. But I suppose it helps give you an indication, right, about where the market is heading, how you're seeing a bounce of sorts come by. So, Mr. Navlakhi, you said you recommend that, if you have an SIP of very hypothetically, say, 1,000 rupees in a small cap fund and a mid cap fund, would you recommend then that they should up it, they should make the calls to, the broker, or simply go onto their, their mobile apps, etc., if they're directly investing, and should they up their SIP amount?
So I'm very biased. I always tell people that you should contact an advisor because your allocation, your goals, etc., are very different from what everybody else's goals would be. So keep that in mind. I think the allocation is critical. So at a time when you have long-term goals to meet and you have a long-term time horizon, and in a mid and small cap, so when we say in the equity index or the Sensex or Nifty, you should look at least 3 to 5 year time horizons. You automatically need to push that to a longer period, say 5 to 7 years for a mid or small cap. So if you needed money which was going to be, something which is 5 years or so away, then certainly you should allocate money for mid and small cap. The proportion, etc., I don't think I want to give a percentage, but I think it is dependent on you, your profile, your risk profile, your goals, etc. But certainly it's not a time to look at 1 year returns or 3 year returns and find that small cap has actually lost money or it's zero return in the last 3 years. So let me stay away because I might, knowing my luck, once I start investing, the markets will start falling, so. Yeah.
I think we've heard that line from almost every individual that, oh, my luck is so bad that the minute I put my money in a stock or in a fund, it starts falling. So I think you hit the nail on the head with that one. Now, while you said that, the percentage depends on the risk profile, on the goals, etc., I think a majority of our callers usually use mutual funds to invest for wealth creation, basically to save up for their retirement. So let's say they have a 10 to 15 to 20 year time horizon, and assuming because of that they can afford to have a very aggressive risk, stance as well. Still, if we have to take an average of how much money should be put in large caps, how much should be put in mid caps, small caps, I'm sure there must be somewhere, some percentage. I mean, should the majority be in large caps? Should the majority be in index funds? How should roughly be the composition?
Yeah, so I think building a portfolio is pretty much like building an apartment, so you first start with the foundation and then you go first floor, then fifth floor, and then 25th floor, so you don't start building the 25th floor before the other things are done. So typically we would recommend that you should have certain large cap index allocation first, then start looking at maybe a large and mid type of portfolio, and then even when you're getting into mid and small cap, it's a good idea to start building that first with index and then going into very active sort of funds. So there are index funds now available which invest in mid cap, the mid cap index and the small cap index. And the advantage of those is that the cost of those funds is much lower than an actively managed fund. So before you jump into it and say, let me put money into an actively managed, good performing sort of fund, I think it's important for you to first get the index and then maybe go into active fund.
Okay, keeping it then with that whole large cap, small cap, mid cap fund mix, we know for a fact that mid caps and small caps are obviously more volatile. When they underperform by a huge margin, and when they outperform also, it's mercifully a similar margin. So there's obviously a lot of volatility. So let's say for someone who does not have a very large risk profile, would you tell them to give increasing their SIP a second thought? Because, while we say that, okay, if small caps, mid caps are, seeing a nice rise, so yes, you should increase your SIP. But what about those guys and those individuals out there who do not want to stomach such increased volatility for whatever reasons?
Yeah, so I think there are two questions in this. So one, increasing your SIP is essentially depending on how much money do you have available with you to invest month on month. And it's a good idea to earmark maybe 60 to 75% of what you're going to save month on month into an SIP. Now, where you put it into an SIP, I think for those who don't want to stomach risk, there is nothing that, forces people to say, you must take more than excessive risk to try and get more than excessive return. If they do not require that return, then it's fine if they remain with index and large cap funds. But they should know that, there will be periods when you will make substantial returns in the small and mid cap space, and they could miss that. So the other way to look at it is that, for people who don't want to take risk, it's also a way of ensuring that they limit the amount that they put in small and mid cap, and that way also they are reducing their risk. So I think it's a combination of that.
Okay, all right, fair enough. So the fact is that yes, we may see a nice rally come by in mid caps and small caps, and of course for all the individuals out there who want to be a part of this rally, mid caps and small cap funds are a great way to do so. Of course, don't look at returns in the last 1 year, in the last 3 months, and then make your investment decisions. Consider a whole variety and a host of things like your risk profile, etc., and then consider, of course, increasing your SIP in mid caps and small caps. On that note, I'd like to take this opportunity to invite all our viewers as well. If you have any questions or queries, be it on investing in small caps and mid caps, on the conversation that we had on your financial profile, you can call in 2499-0300. You can also email us on themoneyshow@etnow.tv. And I think we've already got our very first caller. Akshay from Mumbai is joining us on the phone line. Hi Akshay, good evening. What's your query?
Good evening. So I'm investing about 15,000 in SIP.
Okay.
And most of my funds are exposed towards large cap.
Okay.
I want to increase the quantum to additional 10,000.
Okay.
One, should I invest in large cap? I don't have exposure to mid cap or small cap. So should I go for small or mid cap, or should I try for index fund? The horizon I'm looking for is at anywhere, plus 5 years, like for long term.
So long term. Okay, all right. And I'm assuming you're just investing for retirement, for wealth creation. Do you have a specific goal?
True, that is purely for retirement purpose.
Retirement, so just general wealth creation. Okay, all right, Mr. Navlakhi, he has 15,000 rupees in SIP that's largely in large cap funds. He has nothing in the mid and the small cap space. So we were just talking literally about how now is a good time. So would you advise Akshay as well, who's a long-term investor, he wants to invest for his retirement, he wants to put in another 10,000 rupees. Do you think he should put that in mid caps and small caps? Because that would mean close to 40% of his money in mid caps and small caps if he does that.
Yeah, so I think when he's looking at the incremental amount of 10,000 rupees a month, I certainly think that a small portion of that incremental amount must go into mid-cap space. He can choose of one of 2 or 3 options. So before he even goes to small cap, I think first let's go to mid-cap. So in the mid-cap, there is an option of looking at large and mid-cap funds. So there's a combination of large and mid, so he'll have some exposure to mid. Or as we mentioned that there is a mid-cap index fund, so he can look at a mid-cap index fund before he decides to put money into a pure mid-cap. So my guess is out of the incremental 10,000, let's say he decides 5,000 rupees out of that goes into the mid-cap space. He can choose, which of these type of schemes he should put in. And among the large cap, if he does not have an index fund, then a good idea would also be to look at large cap index with the other 5,000 rupees.
Okay, so basically the entire 10,000 rupees, don't put it all together in your mid caps and small caps, because it's almost then 40% of your total SIP. You mentioned 15,000 is already going in large caps, plus you have another 10,000 rupees. So split it up. You can start off with a mid cap index fund, which like Mr. Navlakhi was flagging off earlier, it has lower costs. It may be a little less volatile as well. But yeah, split it up. Put it in 5,000 rupees in a mid cap fund, and the other 5,000 in a large cap fund, in an index fund if you don't have it already. Okay, let's take on board our next query. Jitendra Singh from Bihar, one of our regular viewers, is joining us now on the phone line. Jitendra ji, good evening. आपके लिए आपका क्या क्वेश्चन है?
मेरा क्वेश्चन है
जी,
हम भारत बॉन्ड ETF में म्यूचुअल फंड के माध्यम से इन्वेस्ट करना चाहते हैं।
ओके,
तो क्या यह संभव है?
भारत बॉन्ड ETF में आपको इन्वेस्ट करना है, इज दैट राइट?
म्यूचुअल फंड के माध्यम से।
ओके, सो भारत बॉन्ड ETF म्यूचुअल फंड ही है सर। एक्चुअली आप इसको एक्सचेंज ट्रेडेड फंड, इसेंशियली जो म्यूचुअल फंड ही होता है, लेकिन उसमें फ़र्क ये होता है कि आप उसको एक्सचेंज में बाय कर सकते हैं या सेल कर सकते हैं। But anyway, Mr. Navlakhi, let me understand from you, and if you could explain to our viewers well in Hindi, do you think the Bharat Bond ETF is a good product to have in your portfolio?
बहुत मुश्किल सवाल है कि जेनरिक जवाब दे कि सब लोग के लिए अच्छा है या नहीं अच्छा है। जैसे आपने बताया मुबीना, ETF म्यूचुअल फंड ही है। फ़र्क ये है कि आप एक्सचेंज पे आपको ये इन्वेस्टमेंट्स को ट्रेड कर सकते हैं, ख़रीद सकते हैं, बेच सकते हैं। तो मेरे हिसाब से आपकी रिस्क प्रोफाइल के हिसाब से आपको ये डिसाइड करना है कि भारत बॉन्ड ETF ठीक है या नहीं ठीक है। हमारे हिसाब से ये एवरेज ऑप्शन है। अगर आप जेन्युइनली फिक्स्ड इनकम या डेट प्रोडक्ट में इन्वेस्ट करना चाहते हैं तो शायद कई शॉर्ट टर्म बॉन्ड फंड्स भी है जहाँ पे आप इन्वेस्ट कर सकते हैं।
ओके, एंड बाय द वे जितेंद्र जी, आई थिंक थर्सडे को CPSE ETF भी खुलेगा, जो जैसे भारत बॉन्ड ETF इसेंशियली डेट मार्केट में इन्वेस्ट करता है, CPSE ETF PSU स्टॉक्स में इन्वेस्ट करता है। तो इसेंशियली सेम जो इंस्ट्रूमेंट्स है वो सेम है, पब्लिक सेक्टर यूनिट्स में इन्वेस्ट करेगा। भारत बॉन्ड मार्केट में इन्वेस्ट करेगा ऑफ PSUs, एंड जो CPSE ETF है वो इक्विटी मार्केट्स में इन्वेस्ट करेगा। So बस फ़र्क तो वो ही है. Anyway, let's move on and take on board our next query. Let's take on board an email query. We have Ranjan Karkera writing in to us. He writes in saying, I'm watching your TV program, The Money Show, regularly and quite impressed by the same. Well, thank you, Ranjan. I'm glad our show helps out viewers like you. Anyway, his question is, I'll be retiring next year when I will have completed 58 years. I have my own house. I'll get a PF and gratuity of a neat 65 lakh rupees. He already has 30 lakh rupees savings as well, which I think will be something that he can get access to by next year. He wants to know where could he invest this money so that he can get 80,000 rupees per month. This would be for his future requirements. So in totality, he has close to 1 crore rupees. He is 58 years old, and I'm assuming that he is going to be relying only on this money now. He needs a good 80,000 rupees per month. 1 crore is the corpus, 80,000 rupees per month. Do you think he should have actually planned for this earlier, Mr. Navlakhi?
Yeah, unfortunately, yes. But I think any time is a good time to start. So first, let's break this down. 80,000 rupees a month means 9,60,000 rupees a year, which effectively is meaning that he has to get almost 10% rate of return to ensure that his corpus remains intact and he can draw this money out. So one of the things that he has to remember is that this rate of return is a post-tax return, because he doesn't want to pay any taxes out of that money, which will essentially mean that he has to take risk and put all the money in equity, because it's very difficult to find fixed income returns of that quantum. The other warning that I would like to possibly make him come to grips with is that 80,000 rupees a month is what he requires now. You know, a few years later with inflation, that requirement might go up. So if his amount is without any buffers, or is it with buffers, we do not know, he has to also worry about that. So I think it is a good idea for him to first look at take the first few years and protect that money that he needs to get, if that's the bare minimum that he requires every month, because liquidity becomes the single most important factor when you're just getting into retirement. So take care of that, and then beyond that, it's really, risk profile and all of that to determine what sort of allocation he would be comfortable with.
Okay, great. And it's always better. That's why we say on the Money Show as well that you have to start early. The younger you are, the more you can benefit from the power of compounding as well, which equity mutual funds have time and again proved are the best instrument to give you that. Okay, all right. Well, with that, we're out of time on this edition of Ask the Money Show. So, Mr. Navlakhi, thank you so much for taking our time, joining us right here in the studios. Well, folks, we'll take a very short break, but do come right back. We'll continue the Money Show.